This chart tracks the stark difference in modern savings account interest rates. The bottom line is the national average yield, hovering at around 0.5%. The line that breaks away represents high-yield savings accounts, which routinely pay around 4%. In finance, there is a standard rule for generating higher returns. To make more money, you have to risk losing it, typically by enduring stock market volatility. Yet with a high-yield savings account, you aren't exposed to the market. Your principal, the cash you deposit, never goes down. These accounts are backed by the exact same federal protections as a standard checking account, ensuring your deposits against a bank failure. So if your money is perfectly safe, and the bank isn't out there gambling it on Wall Street, where exactly are they getting the cash to pay you a 10 times higher yield? This diagram illustrates how a bank operates. To understand your yield, you have to look at how a bank balances two distinct pools of money. On one side are assets. This is the money the bank lends out to the public for things like mortgages and business loans, charging a relatively high interest rate. On the other side are liabilities. These are your customer deposits. To a bank, your savings account is a liability because they technically owe you that money, plus the interest it accrues. The mathematical gap between the high interest the bank collects from its borrowers and the low interest they pay out to their depositors is called the net interest margin. A bank's core profitability and long-term survival rely entirely on maximizing this specific margin. You might have heard banks don't actually need your deposits, simply creating new money on a ledger whenever they issue a loan. While banks create money through accounting, that process leaves them highly sensitive to shifting interest rates. To stay solvent, regulators require a foundation of stable, predictable cash, known as core deposits. Without those core deposits, a bank has to rely on volatile short-term borrowing from other institutions. If those short-term rates spike, or if a sudden panic causes a rush of withdrawals, the bank can quickly run out of liquid cash. Your seemingly boring savings account provides the essential stability that allows the bank to safely make riskier, highly profitable loans without collapsing. But if traditional banks can get away with paying you pennies for that stability, why would any institution willingly sacrifice its profit margin to pay 4%? Traditional brick-and-mortar banks have to maintain thousands of physical branches, ATMs, and tellers. That requires an incredibly expensive physical footprint. Online banks don't have those costs. These two charts compare the profit breakdowns of physical and online banks. Online banks deliberately shrink their own net interest margin. By passing a massive cut of the spread directly to the consumer, they aggressively attract those highly desired, stable deposits. They make less profit on every single individual dollar, but the high yield brings in billions of dollars in volume, making the math work for both the bank and the depositor. There is a practical trade-off for receiving that higher rate. High-yield accounts are not designed to act like checking accounts. If you need to make rapid, day-to-day spending transactions or constantly pay bills, this isn't the right tool. To guarantee that the cash they hold actually remains stable, banks often enforce strict transfer limits or require high minimum balances before you can earn the top rate. Also, that yield is tied to broader economic interest rates. When the central bank lowers rates, your yield goes down with it. Over a long enough timeline, savings rates will generally trail the returns of stock market investments. A high-yield savings account is a straightforward transaction. You provide the essential cash stability a bank needs for its lending engine, and in exchange, they pay you a fair cut of the profits.